We're here to help you make sense of complex financial reports.
Turning data into insight.
Exactly. And today, we're tackling Merit Turizm Yadır Vial Pazar. That's Merit, a company on the Beist Anna Pazar. We've got their consolidated financials and the activity report for the first 9 months of 2025, and we're going to break it down for you, the individual investor.
Right. And our goal here is pretty straightforward. Give you a clear, high-value look at Merit's performance, its structure, and, what might be coming down the pike. Critically, we're using the inflation-adjusted numbers, TMS 29 standard. You pretty much have to.
Why is that so critical here?
Well, look at the 3-year cumulative inflation rate they reported. As of September 2025, it hit 222%. So frankly, any numbers not adjusted for that, they just don't reflect reality. They're not very useful.
Okay, got it. Makes sense. So before we dive in fully, just a quick reminder, if you find this analysis helpful, please do give us a like, subscribe, maybe share it. It really helps us keep these deep dives coming.
Absolutely.
Right, let's start with the basics. Who exactly is Merit? We know hospitality, but what's their actual business model?
Okay, so Merit. Founded back in 1988, part of the Net Group, and this is key. Their core business isn't owning hotels, it's hotel management and operation. Think of them as leveraging their brand Merit International Hotels and Resorts.
Okay, so they're selling expertise and brand power. How do they make money then?
Mostly through fixed base fees for management
Right.
and then operating incentive fees. It's more of an asset-light approach, you see.
Asset light, right. Where are they actually applying this model? Where are their hotels located?
Their geographic footprint is heavily weighted towards one area. They manage 10 hotels in total currently. 8 of those are in the Kuzey Kubrans Turk Cumhuriyeti, the KKTC. That includes big names you might recognize like Crystal Cove, Royal Park, Lyman Hotel.
8 out of 10 in KKTC. That's significant concentration. What about the other 2?
One is international in Bulgaria, the Merit Grand Mosta, and the newest one is Merit Starlet in Montenegro. That just started operations in Q2 2024, so it's pretty recent.
Okay, so KKTC is definitely the core focus. Now, something jumped out at me from the report, their employee count.
Yes.
It says the average personnel across the entire group, including subsidiaries, is only 25 people for managing 10 resorts. How does that even work?
Yeah, that number seems startlingly low, doesn't it? But it actually tells you a lot about their structure. It confirms Merit itself is purely the strategic management hub,
Yeah.
the holding company.
The brains of the operation, basically.
Exactly. They're based in Beşiktaş, Istanbul. They handle the strategy, the brand, the investments, the actual hotel staff, the thousands of people working in the hotels. They're employed by the affiliated operating companies, not Merit directly.
Okay, that clarifies things. A very lean, centralized structure.
Yeah.
Built for efficiency.
Precisely.
Let's talk governance then. We know Net Group is involved. How much control do they have?
Well, Net Holding Dessus is the dominant shareholder, holding 70.30%. The remaining roughly 30% is free float, held by various individuals.
And I imagine that control is locked in structurally.
Yes, very much so. There was a huge capital increase recently, an 1,100% bonus share issue completed in December 2024. That pushed the issued capital up to 336.6 million TL.
Wow, 1,100%.
Yeah, quite something. But the key is the A group shares.
The privileged shares.
Right. Those shares control the election of the majority of the board of directors. So regardless of the bonus share flood, Net Holding maintains strategic control.
Makes sense. And the board itself.
It has 11 members. The chairperson is Hanta Tibuk.
And diversity on the board.
It's, quite low on the gender front. Only 1 woman out of the 11 members. That's about 9%.
Okay. And compensation for leadership.
The report states the total pay for the board and senior management for the first 9 months of 2025 was 5,672,895 TL.
Got it. So this structure, asset-light operations, holding company control it all, seems to point towards the investments being the real story here.
That's exactly where you need to look to understand Merit's financials. It's fundamentally an investment holding company. Look at their balance sheet. Total assets stand at around 15.7 billion TL.
Okay, substantial.
But then you look closer, 15.6 billion TL of that, almost 99%, is sitting in one line item. Investments accounted for using the equity method.
99%. So almost all their asset value comes from investments in other companies?
Correct. Primarily, it's their 26.42% stake in Merit Cobras Turizm Limited. So Merit's huge balance sheet isn't really about their own operational assets or cash flow directly. It reflects the value of the underlying properties and assets held by these affiliates, particularly in KKTC.
Wow. Okay, that completely reframes how you have to view the company. And that ties directly into their strategy and risks, right?
Right.
Because the value of those KKTC assets is tied to, well, external factors.
Absolutely. Let's talk SWOT, essentially, strengths. They have a strong, recognized brand-leading tourism in KKTC. They offer unique concepts like this, Hershey Dahill Plus at Crystal Cove.
And they're expanding internationally. Bulgaria, Montenegro.
Right. But the biggest opportunity, by far, the one everyone watches, it's geopolitical.
You mean changes related to the KKTC's status?
Exactly. The reports explicitly mention the potential huge positive impact if there were, say, direct international flights allowed to KKTC or a broader lifting of its isolation.
That would be a game changer for tourism there.
Immense occupancy, revenue, and crucially, the valuation of those underlying assets held by the affiliates, it could all skyrocket. That political factor really looms large.
Okay, huge potential upside. But there must be risks, too, besides the obvious reliance on affiliates.
There's a very significant, imminent operational disruption investors need to factor in. It's not a maybe, it's happening.
What is it?
The Marriott Crystal Cove Hotel. It's noted as a key revenue driver, maybe their most important hotel operationally. It's closing for a major renovation. It's shut down in November 2025 and isn't scheduled to reopen until July 2026.
July 2026, that's what, 8 months?
Almost 8 months where a core chunk of their operational fee revenue is just gone. That's going to hit the income statement in the next few quarters. You have to bake that expectation in.
Right. A big asterisk for the short to medium term outlook then.
Yeah.
Okay, that context is crucial. Let's get into the actual financial performance numbers for 9M 2025 versus 9M 2024. And remember, these are all TMS 29 inflation-adjusted figures.
Okay, starting at the top line, revenue, or Hasalat. Consolidated revenue saw really strong growth. It jumped 70.7%.
70%. Wow. What were the numbers?
It went from 114.92 million TL in the first 9 months of 2024 up to 196.25 million TL for the same period in 2025. And that growth came mainly from those hotel management and incentive fees we talked about.
Good to see the core operation delivering like that. Did that flow down to operating profit?
It did. Core operating profit at ISA's affiliate at Korea also showed a healthy increase, up 50%, rose from 67.81 million TL to 101.61 million TL year over year. So the management business model itself is performing better.
So far, so good.
Yeah.
But you hinted earlier that this isn't the whole profit story.
Not even close. This is the aha moment for Marriott. Their operating profit was, let's call it 101 million TL, but the company also recorded 337.1 million TL from its share of profit from equity investments in those 9 months.
Wait, 337 million?
Okay.
From the investments?
Yep. That passive gain from their stake in affiliates is more than 3 times their actual profit from running the hotel management business.
So they make most of their money from the increasing value of their investments, not the fees.
Fundamentally, yes. That's the core of their profitability model. It's driven by the value appreciation of those underlying assets, especially in KKTC, reflected through the equity method.
Okay, so that massive investment income obviously boosted the bottom line. What was the net income?
Net income, Donam Net Kara, rose 23.4%. It came in at 414.49 million TL, up from 335.82 million TL last year. So the company is definitely more profitable overall.
More profit, that's good. But then there's this number that looks, frankly, alarming at first glance. Earnings per share, EPS,
Yep.
It absolutely cratered.
Yes, it dropped from 11.97 TL per share in 9M 2024 down to just 1.23 TL in 9M 2025.
That looks terrible. How can profit go up 23%, but earnings per share fall almost 90%?
This is the key paradox you have to grasp. It's all about the denominator, the number of shares. Think of it like this. Marriott baked a bigger profit cake this year, right? 23% bigger.
Okay.
But remember that 1,100% bonus share increase in late 2024. That means they suddenly had to cut that slightly bigger cake into 12 times as many slices.
So the total cake value went up, but each individual slice got much, much smaller.
Exactly. The EPS drop is purely a mathematical result of massively expanding the share base. It doesn't reflect a drop in underlying profitability, which actually increased.
That context is absolutely vital for anyone looking at the stock. Okay, let's shift to the balance sheet health. Liquidity, debt.
Right. Well, the asset side story is unchanged. 99% is tied up in those long-term equity method investments, 15.6 billion out of 15.7 billion TL.
So not much liquid operational asset base there. What about actual liquidity, current assets versus liabilities?
Their short-term liquidity looks very comfortable, actually. Current assets were about 77.5 million TL. And total short-term liabilities were only 34 million TL, so easily covered. Their cash position is noted as tight but stable at around 2.35 million TL.
And debt. Are they leveraged?
Remarkably little external debt. Their total liabilities are very low, just under 41 million TL. And most of that isn't bank loans. It's things like current tax obligations around 28.4 million and payables to related parties within the net group.
So very low financial risk from external borrowing. They're mostly financed internally or through equity.
Correct. Which brings us to equity changes. As Connectler.
Given the profit and the investment revaluations, I assume equity grew substantially.
Massively. Total equity increased by 3.41 billion TL in the period, reaching 15.68 billion TL.
Billion with a B. Wow, where did that mainly come from? Retained earnings.
Some from profit, yes, but the lion's share is again linked to those equity method investments. Specifically, revaluations recognized in other comprehensive income, or OCI. That OCI component related to the investment revaluations stands at a huge 7.67 billion TL overall. It reflects the surging, inflation-adjusted, estimated value of their stakes in those underlying properties and businesses.
It really hammers home that investment holding identity. Okay, what about cash flow? Did the operations actually generate good cash?
Yes, operating cash flow is healthy and improving. It came in at 92.41 million TL for the 9 months, up from 71.28 million TL last year. So the core management business is throwing off decent cash.
And cash flows from investing and financing activities.
On the investing side, there was a big outflow, 263.3 million TL. But this was mainly for capital increases in their subsidiaries. And interestingly, that was largely offset by incoming dividends from those same subsidiaries, which totaled 223.4 million TL.
So cash moving around within the group structure, essentially.
Pretty much. Then on the financing side, the main outflow was the dividend payment to Merit's own shareholders. That was 51.36 million TL payout in June 2025 for the 2024 profit.
Which, as you mentioned, aligns with their policy of distributing the legally required minimum.
You're right.
Finally, you mentioned related party payables. Let's touch on those related party transactions.
Yeah.
Dipnot 5, the footnote. How important is that?
For Merit, it's crucial reading. It underscores just how deeply intertwined the company is with the wider net group. Meaning, managing risk for Merit is almost synonymous with managing risk for the entire net ecosystem. Take receivables, for example. They have total commercial receivables of about 51.5 million TL. Of that, 48.8 million, nearly all of it is owed by affiliated companies like Merit Turizm and Net Holding itself.
So their ability to collect cash depends heavily on the financial health of their sister companies.
Precisely. Their stability is linked. They do mention, for governance context, that their Risk Early Detection Committee met 4 times in the 9 months, so they're actively monitoring these internal dependencies.
Okay, so let's try to synthesize this for the listener. Merit seems like a company of, well, contrasts.
Definitely. It's a paradox in many ways. You've got this lean, asset-light operational model generating decent growing fees.
But that's dwarfed by the massive value and profit contribution from its huge investment portfolio, primarily the stake in KKTC tourism assets.
Right. And it has very little external debt, which is a plus for financial risk.
But its core operational revenue faces a significant guaranteed hit in the coming months due to that Crystal Cove renovation closure.
Exactly. So the core takeaway for an investor, the operating business is solid, but the real story, the main driver of value and potential upside, is tied to that massive, growing, passively held investment stake and its sensitivity to inflation and, critically, KKTC politics.
So here's maybe a final thought for you to chew on. We talked about the huge opportunity. If the political situation normalizes, maybe direct flights to KKTC become a reality. If that happens, how quickly could Merit actually unlock or leverage the value currently tied up in those 15.6 billion TL of equity investments? What can they do with it, and what might that mean for the share price, given how much of its current value is based on those passive holdings?
That's the multi-billion lira question, isn't it? How and when that underlying asset value could potentially be realized or further leveraged. That's the fundamental long-term bet here.
Indeed. A lot to consider. Well, thank you for joining us on this deep dive into Merit.
My pleasure.
And for everyone listening, if this breakdown was useful, please remember to like, subscribe, and share. We appreciate the support.
Helps us keep digging.
It certainly does. We'll catch you on the next deep dive.